Welcome to this week's Lucia Capital Group Weekly video. Now, the first quarter of 2022 has not been good to investors. As of early March, the S&P index was down almost 12% year to date. Most of it the result of pessimism over world events: Russia versus Ukraine, oil shocks, post-COVID supply shortages, inflation fears, and the rest. In any crisis, playing it safe to avoid losing your money can seem like the only rational strategy. This is why many investors tend to bail out at the first sign of trouble, which of course sends the markets down even more. But over the past 60 years, we've seen repeating patterns of crises, and yet the market has been resilient and so far has recovered every time. While it's not predictive of anything, it's helpful to look at some historical crisis events for some perspective. The results may surprise you. 60 years ago, we saw the Cuban Missile Crisis, when over a 2-month period from August to October of 1962, the S&P dropped 9.9%. But 1 month after the crisis ended, it was back up 15.5%. 1 year later, it had gained 41%. And 5 years after it hit the lows, the S&P had seen a 15.8% annualized gain. Then we had the big market crash of 1987, known as Black Monday. The Dow Jones Industrial Average dropped 22.6% in a single trading session. Over the course of 17 days, the S&P dropped an astounding 31.5%. The world was coming to an end, right? Nope. Just 1 month from the crisis low point, it gained 7.1%. And after 1 year, the gain had risen to 27.7%. Now, more recently, we saw the collapse of Lehman Brothers in 2008. In a little over 2 months, the S&P was down an unbelievable 39.1%. But just 1 month after the crisis low point, we saw an 18.3% gain. And going out 1 year, the S&P was up 48.8%. After 5 years, the market saw an annualized gain of 21.5%. And just 2 years ago, between February 12th and March 23rd of 2020, the Dow lost a stunning 37% of its value as the COVID pandemic suddenly burst on the scene. On March 16th alone, the Dow plummeted nearly 3,000 points, losing almost 13% of its value in just 1 day. And then, almost as quickly as it started, values began to creep up again. By August 18th, the S&P 500 was back in record territory. The Dow finished the year up 7.2%. The S&P was up 16.3%, and the NASDAQ Composite Index soared by a whopping 43.6%. The point here is that large, sudden market downturns happen, and there's nothing we as individuals can do to stop them. But we can control our reactions to them. When the market is going down and the news is depressing, the urge to panic and play it safe can be intense. But how you choose to respond to this turmoil can dramatically affect your long-term performance. Investors are more likely to find the courage to go back into the market after things quiet down, which means by that time, they've already missed much of that recovery. We don't panic because we want to help you plan for market declines before they happen, rather than trying to react to a market drop afterwards. Remember, the stock market can drop by 20% or more for reasons you can't even think of, and maybe for no reason at all. With 5 to 7 years of conservative bucket number 1 assets, and maybe another 8 to 10 years of bucket number 2 assets, our goal is to buy enough time for a market to recover. That's what a bucket strategy is all about. If you didn't have a plan prior to these recent events, or if you'd chosen to be a little more aggressive than what we would normally recommend, that's okay. Just give us a call and we'll discuss options with you for adjustments. As always, we're here to help.